Most investors miss this dividend secret. They focus on quick gains and overlook true wealth building. This strategy consistently creates passive income and is a powerful long-term plan. In this video, I bring you the Dividend Snowball Strategy that builds massive income. You invest in top dividend ETFs and automatically reinvest every penny, every payment. Following this path will lead you to unstoppable growth. For example, start with a 10,000 deposit and invest 500 a month into an S&P 500 ETF. In 30 years, this could grow to 3 million, generating 15,000 a year in passive dividend income. If you transfer your funds then to a higher dividend yield ETF, you could earn up to $133,000 annually. The dividend snowball strategy is actually very simple. First, you invest in strong, safe companies. When these companies make a profit, they pay you a portion of it. This is called a dividend. Now here is the secret. Instead of taking that cash and spending it, you use it. You automatically buy more shares of that same company. Those new shares will earn their own dividends later. It is a cycle that feeds itself. Think of a snowball rolling down a hill. It picks up more snow, it gets bigger, and it moves faster. Most investment apps make this easy. They use something called DRIP, which stands for Dividend Reinvestment Plan. You just turn the setting on. For example, in Schwab, when you buy a stock, it has a check that you activate, dividends reinvest automatically. It usually lets you buy fractional shares. That means even small amounts of money are used immediately. And usually there are zero fees to do this. Imagine you start with that same $10,000. Then you add $1,500 a month. After 10 years, your account is already worth over $100,000. Your yearly income is over $5,000. And after 20 years, your yearly income is nearly $18,000. By year 30, you are making almost $50,000 a year in dividends, and your total portfolio is practically $1 million. Finally, after 40 years, the numbers are crazy. You are making $133,000 every year just in dividends, and your total value is over $2.5 million. This happens because the stock market historically helps your money double roughly every 10 years. So what should you buy? This strategy works best with quality companies. Look for the Dividend Aristocrats. These are major companies that have increased their payouts 25 years in a row. There are also the Dividend Kings. These companies have increased their payouts for 50 years in a row. That kind of history shows they are safe, strong, and ready to grow. Think about Procter & Gamble. They have iconic brands. They return 11.3 annually from 1991 to 2022. $1 invested became $31. Johnson & Johnson is another example. It's a stable business. It returned 12.4% annually over the same period. $1 became $42. Coca-Cola has a long history. It compounded at 10.4% annually. $1 became $23. Lowe's is impressive. It returned 20% annually. $1 became $379. The Palmolive, it has a history since 1806. It returned 11.7% annually. $1 became $32. These companies have strong financials. They have competitive advantages. They prioritize shareholders. Between Dividend Aristocrats, look at key metrics. First, the payout ratio. The dividends paid divided by earnings or free cash flow. A sustainable ratio usually is below 60% or 75%. Over 100 is a huge red flag. It means the company paid more than it earned. That's unsustainable. Next, dividend yield. This is the annual dividend per share divided by the stock price. A high yield can be tempting, but yields but over 12% signal trouble. The company might cut the dividend or the stock price might crash. A lower growing yield is often better. It outperforms a high stagnant one. Also, check the dividend growth rate. How fast has the dividend increased? Consistent growth, like 5 to 7% annually, accelerates the snowball. Home Depot, for instance, has grown its dividend over 20% per year. Finally, financial health. Look at strong balance sheets. Consistent profitability, competitive advantages, and healthy cash flows are vital. For diversification, consider ETFs. They manage many dividend stocks. SCHD is a great choice. It's the Schwab US Dividend Equity ETF. It focuses on quality companies. They have over years of consistent dividends. SCHD has 63.89 billion in assets. Its expense ratio is just 0.06%. The dividend yield is 8%. Top holdings include Verizon and Coca-Cola, also ConocoPhillips and Martin. Its 5-year average annual return is 8.37%. Sector allocation is diverse. Financials make 8.31%. Health tech is 15.71%. Consumer durables are 17.59%. Energy minerals are 14.25%. Electronic tech is 11.75%. DGRO is another great option. Shares Core Dividend Growth ETF targets companies over 5 years of dividend growth. It complements SCHD well. DGRO has 27.55 billion in assets. Its expense ratio is 0.08%. The dividend yield is 2.51%. Top holdings are Microsoft, JP Morgan Chase, Apple, also Johnson & Johnson, AbbVie. Its 5-year average annual return is 55.42%. DGRO also has broad sector exposure. Financials are 19.89%. Health tech is 13.62%. Electronic tech is 12.84%. Tech services are durables are 9.73%. These allocations provide strong diversification. They reduce reliance on any single industry. VIMI is another great ETF. It's the Vanguard High Dividend Yield ETF. It focuses on large companies. Pay high dividends, has about 60 billion in assets. Its expense ratio is 0.06%. The dividend yield is 2.8%. Its 5-year average annual return is 11.55%. These ETFs offer diversification. They provide professional management. They have low fees. This makes them excellent for this strategy. This balances current income with long-term appreciation. It creates a robust portfolio. People often compare dividends to growth investing. Such investing chases rapid capital appreciation. Think Amazon, Google. They reinvest profits. They don't pay big dividends. Growth stocks offer high returns. They come with higher volatility. This is for getting rich. However, dividend investing is different. It's about stable, mature companies. They consistently pay earnings. This creates steady income. It's for increasing income with peace of mind. Many investors combine both. It's a core and satellite approach. You might put 70% in dividend ETFs, that's your core, then 30% in ETFs like VUG. If you're younger, you can increase your growth allocation. This balances wealth building with cash flow and manages risk. The S&P 500 Dividend Aristocrats Index often matches or outperforms the S&P 500. It also has smaller drawdowns during market downturns. This demonstrates the resilience of dividend-focused strategies. Stability makes them attractive during uncertain times. A core dividend portfolio could be 70%. A growth satellite could be 30%. Or flip it. Core growth with a dividend satellite. This approach is flexible. It adapts to your goals. During the recent downturns, I added some dividend stocks to my portfolio and it was useful. Besides gold, it balanced the downturn. Now let's look at how to actually build this snowball. This is your first critical step. Your broker needs DRIPs. DRIPs, remember, are dividend reinvestment plans. The process must be easy. It should be free. If your broker charges for reinvestment, switch. Or if the feature is buried, hands-free compounding is the goal. Most DRIPs also buy fractional shares. Every penny goes to work. Look for a history of raising dividends. Focus on Dividend Aristocrats or Dividend Kings. Don't just chase high yields. Ignore the hype. Look at the track record. Vet the stock thoroughly. Check revenue trends. Look at free cash flow. Examine debt levels. Understand the company's overall health. A sustainable payout ratio is key. Below 60 to 75% is ideal. This means room for future growth. These modes protect profits. Look for network effects or entry barriers when they're trading fair or better prices. Never put all capital in one place, spread your bets. Take positions in multiple industries. This protects against a single downturn, ensures a stable income. Target sectors like consumer staples, healthcare, utilities, technology, real estate, financials, and industrials. This balance mitigates risk. Decide your target. Now that you know what to buy, you need a system to buy it. If you are picking individual stocks with 15 to 20% per holding, if you are using ETFs like SCHD or DGRO, a simple 50/50th or 70/30th split works perfectly. Once decided, turn on DRIP immediately. It's the engine of this entire strategy. You don't need to do it manually. Next, set up automatic contributions, whether monthly or quarterly. Consistency is key. This is called dollar cost averaging. By buying at regular intervals, you buy more shares when prices are low and fewer when they are high. This naturally reduces your average cost per share and smooths out market volatility, accelerating the snowball effect. To make this work, you need to fuel your snowball by funneling every unexpected windfall, tax refunds, bonuses, or side hustle money directly into your portfolio. This requires a gap between your income and your expenses. Live below your means. You don't need to copy Warren Buffett's lifestyle to understand his logic. Every dollar you don't spend on luxury goods is a soldier you can deploy to capture more territory in the market. Avoid high interest debt like the plague. It is a guaranteed negative return on your wealth. Where you hold these assets matters just as much as what you buy. Utilize tax advantage accounts like IRAs, Roth IRAs, and 401ks. In a taxable brokerage account, you owe taxes on dividends every year, which creates a tax drag. Roth IRA grow completely tax-free. If you change jobs, always roll over your 401k into a consolidated IRA. Never cash it out. The penalties and loss compounding time are devastating. Remember, this strategy is low maintenance, but not no maintenance. Review your portfolio once or twice a year. Check the fundamentals. Is the company's cash flow still covering the dividend? Is the payout ratio sustainable? If a company cuts its dividend or its business model breaks, don't be afraid to sell and reallocate that capital to your winners. However, do not sell on fear. Emotional investing is the fastest way to destroy wealth. The market is counterintuitive. People rush to buy when stocks are expensive and flee when they are on sale. Disconnect your emotions from your money. Stick to the plan. Avoid reading financial news. However, we have to be realistic. The dividend snowball is not a get rich quick scheme, it's a get rich slow one. It requires significant capital. To generate $2,000 a month in dividends at a 3% yield, you need a portfolio of roughly $1,800,000. That takes time to build. You also face inflation, but we're here for the long term. This is not day trading. 2,000 a month sounds great today, but with 3% annual inflation in 30 years, you will need nearly 5,000 a month just to buy the same amount of groceries. That is why you cannot just chase high yields. You must prioritize dividend growth. You need companies that raise their payouts faster than inflation to protect your purchasing power. And my final recommendation, but not financial advice. If you are starting with a small account, focus on accumulation first. Buy a broad market ETF like VTI, turn on auto invest, and focus on increasing your income.